For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another Saturday Sendout from the Simple Side. We had one of the busiest earning stretches of the summer, which was supposed to cement AI as something that was going to drive the market higher, but July crashed. Let's talk about it.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste. Join the Simple Side.
All right, everybody, like I said, welcome back to the Saturday Sendout from the Simple Side. If it's your first time listening to the podcast, welcome to the podcast. We're going to quickly go over all of the information contained in today's newsletter, and I'll give you a bit of information as well about all of our copy trading and our portfolios going forward. All right, let's start with everything that subscribers to the newsletter get for free, which is our commentary on this past week and things that we see coming up over the next week. Like I said before, it was the busiest earnings stretch of the summer, which was supposed to cement the AI lifts all narrative. We, of course, did not see that happen. We had 5 trading sessions which delivered a sharp reality check. A one-day spike in Microsoft and Meta could not prevent the S&P 500 from sliding 2.4% for the week, and the Nasdaq came back 2.2%. By Friday's close, every major US index had logged its worst weekly loss since April. Treasury yields, were on the fall. We also saw an early September rate cut kind of jump out of existence. The VIX was printing money, though, a 20% return for the first time in 6 weeks. Now, even though the market ended lower, there was a few things that moved the market in between the beginning and the end of the week, and one of those was the earnings euphoria. But even with that euphoria, we saw a lot of negative guidance over the next couple of weeks or months or years or whatever you want to call it. But we basically saw Microsoft have a blowout Azure quarter, and Meta's record ad revenue sparked a mid-week melt up. We saw both of those companies climb up, I think, over 5 to 10%, both companies on the news of their earnings. But the optimism faded quickly as Qualcomm, Amazon, Apple, United Health, and Novo Nordisk all trimmed their outlooks. Everything else was negative, and it started to bring the market down quite a bit. People were reminded that AI spending can raise revenue ceilings, but still crush near-term margins and balance sheet flexibility. Again, we're not expecting AI to drive any sort of substantial change to companies' bottom lines yet. They might be good places to start cutting costs, but in the the short term, we're going to see a lot of money being spent on AI and not a lot being saved. There were a few mega deals announced this week. We saw Union Pacific's agreed takeover of Norfolk Southern come to light. It's going to create the first coast-to-coast American railroad ever. We also saw Baker Hughes bid for Chart Industries. And of course, that's going to redraw the LNG equipment map. For those of you that don't know, LNG is liquid natural gas. We saw Palo Alto's $25 billion purchase of CyberArk and a Palantir contract worth $10 billion hit from the Army. Of course, investors cheered the synergies. Regulators have signaled that rail, security, software, and defense consolidations will not sail through. Completely unchallenged, though. There's definitely going to be a few headwinds, but the Trump M&A market is probably going to continue, and a lot of these things are not going to get blocked, which should be no surprise. As we saw, Trump said he's a big fan of deals and wants to get a lot of them done. I doubt that he's going to be blocking a lot of these company mergers. Looking globally, we saw supply chains continue to decouple. Samsung landed a $16.5 billion long-term chip contract. Huawei unveiled an AI server that claims to beat NVIDIA's newest rack, and Tesla lined up $4.3 billion in Korean-made LFP batteries to cut out their Chinese exposure. At the same time, Washington broadened tariff coverage to Canada, India, and Taiwan, We also saw the EU agree to commit $600 billion of fresh investments into the US as part of its 15% tariff settlement. Boards are budgeting for permanently higher operating friction, and I think that is likely going to be the way things are, at least in the foreseeable future. It is going to be a very interesting earnings year following this year and in the following quarters. It's going to be very interesting to see how all of that ends up playing out. But if there's one thing that you should be paying attention to, it is how the macro mood swung from resilient to fragile in just 48 hours. On Tuesday, we saw consumer confidence hit a 3-month high. Then we saw negative news in a payroll report. We saw rate cut odds drop quite a bit. And then we saw utilities and other defensives be the gainers for the week, which signals low confidence in people shifting into defensive sectors. Again, a crazy shift from Tuesday to the end of the week. Now, if you want to see that negative sentiment play out in real life, you can take a look at how sectors performed this week. Technology finished lower, even though Microsoft had a 9% gain. We saw Meta with an 11% gain. And of course, we had weak semiconductor guidance, but that ended up bringing technology down overall, which we did not expect to see. In the communication services, we saw Meta holding everything flat, but consumer discretionary dropped alongside Tesla and Amazon as margin pressures became the new buzzword for everybody who's all doom and gloom or bearish on the current market. Industrials fell nearly 3%. We saw rail equipment suppliers rally on the Union Pacific in SC news, but airlines and parcel carriers sagged after the UPS cost-heavy quarter, and I don't think that is going to change anytime soon either. There is no way that AI is going to save UPS on labor, at least in the short term. It's going to be a rough quarter, rough year for them. Healthcare lost almost 3%. We saw GSK licensing spree happen. We saw AbbVie send out news about a possible $1 billion deal, and Novo Nordisk guidance cut drug everything down with it. Energy gave back early gains despite $69 crude oil demand, and assumptions were revised lower in several conference calls over the past week. Now, in fixed income and currencies, we saw the 10-year fall 19 basis points to 4.22%. We saw the 2-year drop to 3.7%, and the implied September rate cut probability is now 86%. The dollar slipped modestly. Gold rallied above 3,400, showing some bids for those safe haven investments. Now, for the coming week, you're going to want to pay attention to the July CPI and PPI reports. We've also got congressional hearings on the rail consolidations that are happening right now. Watch what OPEC is going to do. We want to see if Brent stays below 70 or if it's going to start to rise. And of course, Apple and Amazon follow through trades. They both issued cautious guidance despite record quarters, and it brought things down. We're going to wonder if this is going to increase downside in the near term or if we're going to see things start to run back up. All right, now we get to talk about the fun stuff. We get to talk about our weekly picks performance. Of course, for those of you that don't know, our weekly picks are made every single Saturday, and we trade them on Monday. We buy them on Monday, and then we sell them at Friday close. Of course, there are some stop losses and max profits for those picks every single week. But we have been doing very, very well. And the reason why we are doing well is because of something called the dumb money thesis. Now, if you want to go read about the dumb money thesis, there's a link in the newsletter. Again, you can find the newsletter at thesimpleside.substack.com. And I really think you should go and read that and pay attention to what's happening. The only reason that I am even doing weekly picks is because of the dumb money thesis. It's basically the reason behind everything that I'm doing right now in the markets. Just the idea that people are trying to capture alpha, but they have no idea how to do it, and therefore they are trading on news. And so we basically do the same thing, but in a bit of a smarter fashion, and it has worked out very well for us. Over the past 54 weeks, we've returned 69.68%, while the SPY over the same period of time has only returned 13.4%. So we're outperforming the market just on these weekly picks. And again, I'm not even a fan of doing any kind of really short-term trading, but in the current market environment, it works too well to let all that alpha go unrealized. Again, if you're looking at the newsletter, you can go and see how we've performed against the market every single week over the past 54 weeks. Go pay attention to that and let me know what you think in today's newsletter. Continuing on, we're going to talk about the interesting trade ideas that I've been discussing here on the podcast. One of them has been UNH, United Healthcare, and they have been struggling like never before. Of course, they're back down under 50%. They're probably below 50, 60% under their 52-week high, but they aren't the only one. Companies like Elevance are also down just as much. Elevance is trading at a forward PE of 7.98, and UNH is trading at a forward PE of 10.65. For these companies, these are extremely, extremely low. I would say that over the next 3 to 5 years, we are likely going to see both of these stocks make major gains. They're just trading too cheap for them not to come back up. And the majority of both these companies are owned by institutional money, ETFs, mutual funds, that sort of deal. And I don't think these companies are going anywhere anytime soon. Of course, last week I said that you needed to get in on the Figma IPO, that it was going to explode. If you picked up shares at that $33 IPO price, then you made out with a 200+% gain last week. Of course, just over a couple of days was your gain on that. If you got shares on the drop at $85, then you came away with 50 to 70% returns. If you ended up selling, congrats. Like I said, this IPO flipping, this IPO buying is going to be very profitable, again, in line with the dumb money thesis. Now, of course, if you're a paying subscriber, you get to go down and look through all of our picks for this week. Like I said, these picks are up something like 67, 69% over the past 55 weeks. However, over the past year, so year to date, we're up 46%, which is just crazy, crazy, crazy returns. And we couldn't be happier with those returns either. Of course, we have other portfolios as well that we're going to be sharing with people. All of that is going to be released very soon to you all. I'm really excited to get that out to everybody. The last thing that I want to leave you with is that you need to be paying attention to the newsletter over the next couple of weeks, because I am releasing on a new copy trading platform, and I want everybody to get in at the budget price that it's set at, because the price will be going up. I am probably the cheapest currently on the platform, so you want to go and get in at a good price. I'll be telling you more about it in the coming weeks, and I will see you soon.